Welcome to the Real Estate Way to Wealth and Freedom podcast with Jacob Ayers, providing actionable content to help you along your journey to financial freedom through real estate investing. As the premier asset class, real estate has helped ordinary people just like you amass fortunes. The benefits of passive income from real estate investing will allow you to live a life you want. And now your host, entrepreneur, real estate investor, and apartment deal syndicator, Jacob Ayers.
Hi, and welcome to the Real Estate Way to Wealth and Freedom podcast. You're listening to Friday Fundamentals with your host, Jacob Ayers. I want to take this episode to discuss some of the fundamentals we've talked about with our guests so far. We've interviewed a number of successful real estate investors, attorneys, commercial lenders, and apartment deal syndicators. We've talked a lot about building your team, developing a winning mindset, partnerships, and the power of leverage. We've focused on multifamily investing and syndicating apartment deals, but do you know why? In this episode, we're going to dive deeper into that. So this week's Friday Fundamental is why multifamily? So why multifamily investing exactly? Well, let's take a look at the business model in a very simple way. As a multifamily investor, you borrow other people's money to buy a property. You then hire a property manager to manage that property. The tenants pay the debt for you, and the extra money left over goes in your pocket. Talk about leverage. You're leveraging other people's time, money, and resources. But this doesn't mean you're the only one winning in this game. When done correctly, everyone can win. The bank gets paid interest on the money they loan you. The broker gets paid a commission on the purchase and sale of the property. The property management company gets paid to manage the property. The tenant has a nice, clean, safe, affordable place to live. The investors receive a return on their money invested in the deal. And the seller gets a fair price for their property when they sell it to you. The buyer gets an efficient, income-producing property when they buy it from you. It's a win-win for everyone involved. Multifamily investing is scalable. You can start out small, say 6 to 10 units, and the same principles still apply for 200-unit properties. Our guest Reed Goosens started with duplexes and is now involved in 200-plus unit apartment deals. So by now you're familiar with the syndication model. Real estate syndication is essentially just pooling funds to buy an asset. So let me ask you this. How many apartments would you buy if you could use other people's money to buy them with? Well, I would want as many as possible. Now keep in mind, you can syndicate single-family homes too, but imagine how much harder it is to buy 100 houses versus a 100-unit apartment building. That's 100 transactions versus one transaction. 100 roofs to maintain and repair or replace versus one. You see, those economies of scale are what allow you to expand and scale up. There are many people who have gone with a single-family home route though. Think back to our very first guest, Rod Cleef, in episode 1. Rod started out buying single-family homes in Denver and bought over 1,200 homes before he transitioned to multifamily deals. Rod will be the first to tell you how much work that was and the inefficiencies involved. Warren Buffett, one of the most successful investors of all time, said he would buy up a couple 100,000 single-family homes if it were practical to do so. Now next, let's talk about cash flow. Above all else, cash flow is the most important aspect of investing in multifamily properties. A multifamily property value is determined by the net operating income, or its cash flow. Since multifamily properties can't be compared to each other, the net operating income is a metric that determines the return of the property. Unlike single-family properties where the value is decided by comparable properties, multifamily properties can't be compared to one another. There are just too many differences between, say, a 24-unit Class C property and a 150-unit Class A property. Therefore, the property is valued based on its net operating income. As an investor, this cash flow is important. It is your passive income. We've talked about the power of leverage with commercial lender turned investor Michael Becker. Leverage is where the true power of real estate investing lies. By intelligently using debt, you can control $4 of real estate for every $1 invested. That is the same as a 75% loan-to-value ratio or a 25% down payment. Now, some people have conservative views of debt and don't understand the differences between good debt and bad debt. Bad debt includes things like credit cards and vehicle loans. If you've read Robert Kiyosaki's book, Rich Dad, Poor Dad, which is referenced a lot throughout this podcast, you'll recognize that the bad debt just mentioned are all liabilities, which means they take money out of your pocket every month. Assets, on the other hand, put money in your pocket every month. Good debt is debt you've used to control an asset like an income-producing rental property or a piece of ownership in a company. By utilizing good debt, you're able to grow your wealth with the help of leverage. The power of partnerships is also something we've discussed quite a bit. Joe Fairless credits much of his success to partnering with the right people. Multifamily investing isn't an individual sport. It takes a team of professionals to be successful. I've mentioned the power of we several times in context to partnerships. If I don't have any experience investing in apartments, but I partner with someone who does, then we now have that experience. It's as simple as that. By partnering with someone, you're leveraging their strengths, whether that be capital, experience, knowledge, their network, etc. For me, multifamily investing checks a lot of boxes. When I look at my reasons why and my goals, both of which we talk a lot about throughout this podcast, multifamily investing is the vehicle that makes the most sense for me. I don't want to just become financially free. I want to build enough wealth to do massive good in this world. Things like build schools in third world countries and help end world hunger through organizations like Meals on Wheels. I have a soft spot in my heart for children in poverty, so anything I can do to help people like that inspires me. Two of our guests, Brian Robbins and Paul Moore, have partnered in business due to their similar reasons why. They have coined the term social entrepreneurship. They have both done a lot to fight human trafficking, and their efforts have touched many already. Things like this inspire me to achieve massive success through real estate investing. So I challenge you to identify your reasons why, set goals, and come up with a plan to get you where you want to be. That wraps up this week's Friday Fundamentals with Jacob Ayers. If you're getting value out of the show, please let me know by leaving a rating and review. And please subscribe to the show to be notified of future episodes. You can now find the show on iTunes, Google Play, Stitcher, Spreaker, iHeartRadio, and TuneIn Radio. If you have any questions or comments or want to hear something specific on the show, just let me know. Email me at info@jacobayers.com, contact me at www.jacobayers.com, or connect with me on Facebook at The Real Estate Way to Wealth and Freedom. Till next week, signing off, I'm your host, Jacob Ayers.
You've been listening to the Real Estate Way to Wealth and Freedom podcast, providing you actionable content to build your real estate empire. Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for personal advice. The opinions of guests are their own. Information is not guaranteed. All investment strategies have a potential for profit or loss. The host is operating on behalf of the Real Estate Way to Wealth and Freedom, LLC, exclusively.